Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing enterprise product stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Enterprise is a midstream natural gas and crude oil pipeline. It was founded in 1968 and its headquarters are in Houston, Texas. It has 51,000 miles of pipeline. It can also store up to 192,000 barrels of natural gas liquids. Let's get started with the model. This is a large cap company, 43 billion market cap. They're trading at $19.74 a share and they have 2.2 billion shares outstanding. Let's look at the financials. The way you value a company is you forecast the free cash flows into the future and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and growing free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And then net income also grows a lot from 2.8 billion to 4.5 billion. Revenue is the sales for the company, and that does grow a lot from 2017 to 2018, but then drops the next 2 years. Their net profit margins are improving each year. They're becoming more efficient. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. And in the trailing 12 months, they converted 16% of their revenue into profit, which means 84% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Then below that is the gross profit, which is revenue minus cost of revenue. Their highest revenue was in 2018 at 36 billion, and the lowest revenue was in the trailing 12 months at 28 billion. Yet their gross profit was higher in the trailing 12 months when compared to 2018. Below gross profit is operating expenses, and then below that is operating income. The company also has a good amount of debt, so they have to pay interest payments on their debt. Then there's other income and expenses, and then of course taxes. So their net income has been over $4 billion the past 3 years. This is the company's statement of cash flows. The top line is the operating cash flow. That's how much money the company generates from its operational business. Then you have capital expenditures, which are really high for midstream companies. This is investments in property, plant, and equipment. And the way you calculate free cash flow, it's operating cash flow minus CapEx, and that was $2 billion in the trailing 12 months. That's pretty similar to 2019, but much higher than 2018 and 2017. They issued $1 billion of capital stock in 2017, $500 million in 2018, and then $82 million in 2019. When a company issues common stock, it does dilute the current shareholders. If this was convertible preferred stock, this may dilute current shareholders in the future. You can see the company issues tons of debt, 69 billion, 79 billion, 58 billion, and 20 billion. They do pay down a lot of debt, but they issue about $1 to $2 billion a year more in debt. They did repurchase some capital stock, but not nearly as much as they issued. The most important part of any business is their operational cash flow, because if you don't have positive operating cash flow, you don't have much of a business, because you don't want to rely on debt and equity to run your business. And the way you calculate operating cash flow, you take net income, which was 4.6 billion, and then you have to add back or subtract the non-cash items from the income statement. They pass through a $2 billion depreciation expense, so we have to add that back on the statement of cash flows. They also pass through a $500 million gain on the income statement, so we have to subtract that from the statement of cash flows. They also had negative $740 million in changes in working capital. This is changes in accounts payable, accounts receivable, inventory, things like that. So the company did generate about $6 billion of operating cash flow, which is really good. A bit less in 2019 and a little less in 2018. Let's look at a capital structure. They have $25 billion of equity, $27 billion of debt, and also $27 billion of net debt. Their WACC is 9.5%, which is a blend of the cost of equity and cost of debt, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $42 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $37 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of $17. They're trading at $19.74, so they're trading at a 15% premium. It's a sell according to the model. Simply Wall Street saying the stock is worth $30. They're saying it's undervalued. You can see I'm expecting their future free cash flows to grow in the future, but I'm still coming up with a valuation much lower than simply Wall Street. The stock was trading between $25 and $30 for several years. Then it took a real big dip in March. It's come up a little bit, but it's still way below its all-time highs. The company pays a 9% dividend, and that's an 86% payout ratio. The way you calculate payout ratio, it's dividend payment over net income. So they pay 86% of their net income in dividends, but they pay 186% of their free cash flow in dividends. A big reason the company has so much debt is because they need to fund their dividend payments. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $17,200 today. If you did not reinvest the dividends, you'd have about $17,100 today. The company has a beta of 1.35, so the stock moves a little more than the market, so it's not too volatile. And in the past 52 weeks, the stock has struggled, down 29% when compared to the S&P 500, which was up 15%. The 52-week low is 1027, and the 52-week high is 2922. The stock is trading above its 50-day moving average and 200-day moving average, so it seems to be on an uptrend. And when the 50-day moving average crosses above the 200-day moving average, that's called the golden cross. That's a bullish signal. About 8 million shares are traded each day for this stock, and of the 2.2 billion shares outstanding, 1.5 billion are on float. Only 32% of the shares are held by institutions. And it does have a pretty low short percentage. Only 2.36% of the shares are shorted. Enterprise owns 31% of the shares. So these are the shares that are not available to investors. These are the shares that are not on float. Then Harvest Fund owns 2%, Tortoise 1.2%, then Blackstone, then Goldman. Let's look at their financial ratios. The average PE in the market is 12.5, the median is 14.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 9.5, much better than the median average. That means investors are paying $9.50 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.5, also a really good ratio. Price to book is stock price over book value per share. They're at 1.7, another good ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and that's $26 billion. But the tangible equity is $16 billion, so they have about $10 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. ROE is net income over equity, so they have a pretty solid ROE. Current ratio is current assets over current liabilities, so they cannot cover their current liabilities with their current assets. And their main current assets are $4.9 billion of receivables and $2 billion of inventory. So the company may have enough money to get through the next 12 months without taking on more debt. Their free cash flow was $2 billion, but they have negative $1.3 billion of working capital. Working capital is current assets minus current liabilities. And the best way to look at ratios to compare them to similar companies, I did videos on 43 midstream companies, and this is the average for all 43. Their PE ratio is worse than average, but they do have better price to sales and price to book than the average. They're not doing well in current ratio. ROE, they're double the average. They are lower in debt than the average, and they're a really big company, 43 billion market cap, much bigger than average. But their dividend is lower than the average because this industry pays a huge dividend, 10.3%. So to summarize, I do have them trading at a 15% premium because it does still seem like their stock is slightly overvalued, at least based off of the future free cash flow expectations. But their ratios look pretty good, and they're a really big company, so they're going to be around for a long time. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.